Financial Reporting Through the Lens of a Property Casualty Actuary. Part 8. The Future of SAP. Introduction to Part 8. Regulation and financial reporting of insurance companies has evolved over time. The original FASB accounting standard for insurance entities, FAS 60, was discussed and developed in the 1970s and adopted in June 1982. The NAIC codified its statutory accounting principles effective January 1, 2001. Today we see the implications of the work performed by the FASB and the IASB on insurance contract accounting and the NAIC's Solvency Modernization Initiative, SMI. So what is driving change today, and where are we headed? Chapter 30. The Future of Financial Reporting and Solvency Monitoring of Insurance Companies. The NAIC and the Financial Sector Assessment Program. In Part 6, Differences from Statutory to Other Financial or Regulatory Reporting Frameworks in the U.S., we discussed the reasons behind the development of new accounting standards for insurance contracts by the Financial Accounting Standards Board, FASB, and the International Accounting Standards Board, IASB. The National Association of Insurance Commissioners, NAIC Solvency Modernization Initiative, was started in part because of pressure to conform to new and evolving international standards. In November 2008, at a G20 summit during the global financial crisis, the G20 members agreed to undergo periodic peer reviews of their financial services regulatory regimes. This peer review process was developed by the International Monetary Fund and the World Bank in response to the financial crisis in the late 1990s, but had mainly been applied to developing countries. This peer review process is called the Financial Sector Assessment Program. The NAIC participated in the FSAP process during 2010 for the first time, and again in 2015. The assessment process benchmarked the U.S. insurance regulatory regime against the Insurance Core Principles, or ICPs, developed and published by the International Association of Insurance Supervisors, IAIS. The results of the 2010 assessment were generally favorable, but were based on the ICPs published in 2003. In October 2011, the IAIS published a revised set of ICPs, with amendments to certain of the ICPs published through November 2018. This revised set of ICPs were used to perform the 2015 FSAP review. In 2015, FSAP concluded that while there were improvements since 2010, there remained difficulties in assessing the health of the U.S. insurance sector. In particular, capital adequacy at legal level, measured by the regulator's risk-based capital, or RBC requirements, has increased since the crisis, and the number of companies breaching regulatory levels has declined. However, capital adequacy ratios are hard to interpret due to valuation rules, regulatory arbitrage via captives, and lack of regulatory capital adequacy measures at group level. The report also noted that one area that still poses a challenge is ICP 14, valuation. ICP 14 states the following: the context and purpose of the valuation of assets or liabilities of an insurer are key factors in determining the values that should be placed on them. This ICP considers the valuation requirements that should be met for the purpose of the solvency assessment of insurers within the context of IAIS risk-based solvency requirements that reflect a total balance sheet approach on an economic basis and address all reasonably foreseeable and relevant risks. ICP 14 also states that an economic value should reflect the prospective valuation of the future cash flows of the asset or liability, allowing for the riskiness of those cash flows and the time value of money. Some may argue the current statutory valuation of property casualty liabilities does not comply with this statement, as it doesn't reflect the time value of money, except in limited circumstances, nor the underlying risk. The 2015 FSAP found that the U.S. insurance regulatory regime only partially observed this ICP. It recommended allowing for conservatism explicitly in a margin over current estimate would increase transparency. The explicit decomposition of reserves into a current estimate and a margin over current estimate allows reassessment of the overall conservatism for different lines of products. This would allow a recalibration of the valuation standard for products where reserves are overly conservative or not sufficient. ConFrame, Solvency II, and the Federal Insurance Office. In addition to the revised set of ICPs, the IAIS has been developing a common framework for the supervision of internationally active insurance groups, commonly referred to as ComFrame. The final framework was published in November 2019. U.S. regulators have expressed concerns about the valuation approach under ComFrame, which requires a margin over the current estimate for valuation purposes, also known as a gap plus valuation approach. U.S. regulators have instead proposed allowing an aggregation approach based on current local requirements in determining the required amount of group capital. As a compromise, there will be a 5-year monitoring period to assess gap plus valuation and its effect on the prescribed capital requirement versus the aggregated approach proposed by U.S. regulators. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 created the Federal Insurance Office, or FIO, which has several functions. The relevant functions are to coordinate federal efforts and develop federal policy on prudential aspects of international insurance matters, including representing the U.S. as appropriate in the IAIS and assisting the Treasury Secretary in negotiating covered agreements, bilateral or multilateral agreements entered into by the U.S. regarding prudential measures with respect to the business of insurance or reinsurance, to determine whether state insurance measures are preempted by covered agreements, to consult with the states, including state insurance regulators, regarding insurance matters of national importance and prudential insurance matters of international importance. Effectively, this gives the FIO the power to act like a national regulator for purposes of negotiating the contents of ComFrame and its group capital requirement, as it can preempt state law if the director of the FIO determines that the measure results in less favorable treatment of a non-U.S. insurer domiciled in a foreign jurisdiction that is subject to a covered agreement than a U.S. insurer domiciled, licensed, or otherwise admitted in that state, and state law is inconsistent with a covered agreement. In addition to the FIO, Dodd-Frank gave the federal government powers to regulate systematically important financial institutions, SIFI. What financial institutions are systematically important is determined by the Financial Stability Oversight Council, a body set up by Dodd-Frank to reduce the risk of any one company being too big to fail. The future. All the above activities by the NAIC, FASB, IASB, IAIS, and the FIO leave us with a very muddy picture of how insurance liabilities will be evaluated in the future. The common theme, though, is change, as each proposed framework differs from the current valuation of insurance liabilities today. Several scenarios could play out that would leave us with several different frameworks in place. Yet, any of these changes individually would have one common result: a greater need for actuaries to perform the additional calculations and explain the drivers of the results.